Gentlemen, take your seats. Let me set this up, because this is going to be quite a panel. Just for full transparency and disclosure, this is being broadcast around the world by LinkedIn because there's so much institutional interest in the answers these gentlemen are going to give today. And so they're going to be heard, and why it's important is, here's an opportunity, problem and an opportunity. I like to frame things yin and yang. Here's the problem. ESG and sustainability has entered into this market very quickly, very rapidly, on an uncontrolled basis. There's a dialogue going on that creating Bitcoin is bad for the environment. And it's taken on many different forms. It's found everywhere around the world. There's governments making policy decisions, uninformed policy decisions, about the sustainability metrics around mining coin. And it has in fact hurt the capital markets for the ability for miners, these gentlemen and others that wish to raise capital, to do so. That's the problem. Here's the opportunity. Bitcoin itself, whether you believe it's an asset, whether you believe it's a property, whatever you believe it is of great interest to institutional managers. That would be pension plans, sovereign funds, and yet they own none. Now, why is that? Let me walk you through the decision-making process. I work in that world. I service institutional clients, sovereign, pension plans, you name it. What's happened over the last 36 months is that they are all beholden now to what are called ESG committees, sustainability committees, whether there's ethics committees on top of that, but also committees that concern themselves with the origin of assets, and they actually have a filter. They make decisions around ESG, and they say you can or can't own that asset. It's not sustainably created. Not just Bitcoin. This goes for many other asset classes too, which is why there's a lot of debate going on. Now, here's the opportunity. If those institutions were just to take a 3% weighting, which is very typical in an asset or a stock or a bond or land or property, it would represent $1 trillion worth of purchasing of Bitcoin itself. The increase in value would be geometric from where it is today. So everybody in this room, everybody, is incentivized to solve this problem for those institutions so that we can unmask this log jam for what it is. A tremendous amount of interest of capital that wants to come into this asset class that can't do it right now because it's got the wrong messaging around it. Because the truth is, as we'll discuss in a moment, that Bitcoin is actually good for the environment because it's forcing these miners to find the most efficient way to create the power to do the mining. There's no other industry that does that. But as a sector, as an industry, as a voice, we have failed. We have not delivered that message successfully, and it's going to start here today. All right? So let's start with Frank Holmes, who I thought he was going to spray paint himself green today. Let's talk about this problem, Frank. Let's get it right out here. I want to deal with the giant elephant in the room. Sustainability. How are you dealing with it in communicating with your own shareholders?
Well, as you know, we're both fund managers, and I'm the chief investment officer, and I was trying to launch a Bitcoin ETF 4 years ago and quickly recognized at that stage it wasn't going to happen. And so this knowledge, I applied it and launched with a couple other investors, the first public company to do crypto mining. And because of a fund manager, we had an ESG strategy at the beginning. And we were only in green energy at the beginning, and we've done through the whole piece. But all the miners have gone down with this sort of thesis of we have to educate those sovereign funds, those other institutions, and I see a big change happening within the industry of reporting and transparency. But Hive blockchain itself, we mine both Bitcoin and Ethereum. We are mining in Sweden and Iceland, in Quebec and in New Brunswick, and we're only green energy. So
what
I feel
is your
comfortable with this.
I'll ask this of Jason actually. What is your definition of green energy specifically when asked by an investor? What does that mean to you? What's green?
To me, green energy is renewable sources. So
specifically, what would they be?
I would include hydroelectric. I would include solar. I would include wind. And I know it's not popular, but I would include nuclear. Nuclear is a good renewable source of energy.
Fred, same question to you. When an investor asks you, what are you calling green?
I think I'm aligned with Jason. It's wind, it's solar, hydro, geothermal, nuclear also.
Okay. Let's make it more complicated. An institution that doesn't own Bitcoin now comes to you and says, look, we're going to make an allocation. We're going to tiptoe in, 1.5% weighting on a $2 billion fund. It's a serious amount of money. But we have to know the provenance of the coin because our compliance committee won't let us offset it with a carbon credit. We have to know that it was mined sustainably, and in some cases, ethically. How do you answer that?
So when it comes to mined sustainably, you have the opportunity to use a blend of power. Most PPA agreements are really a recipe of power. You're going to get so much wind, you're going to get so much solar, you're going to get so much offset. And you also have the ability to use RECs, which are renewable energy credits. So I think, as institutions look at it, they want to make sure that we're not greenwashing our mining operations, but rather that we're actually using a certain amount of truly renewable and then a certain amount of RECs to offset what would be clean natural gas, for example.
Okay. So, Jason, do you see a time, and this has been a very controversial topic that's been spoken of recently, that somehow we would tag green coin versus non-green coin, that there would be two asset classes within Bitcoin? Do not shoot the messenger.
I think an important property that makes Bitcoin valuable is that it's fungible. And one Bitcoin is always one Bitcoin, no matter where it comes from.
So, back to you, Frank. When an institution says, look, I'm going to do a weighting, I want to buy $1 billion worth of coin, and it has to be, check the box with my sustainability committee, even though we know that this is an unusual dialogue to be having, but it's got to be dealt with. How do you solve it?
I'm sorry, Kevin, I cannot. Your question is?
It's this. I need a sustainable coin,
Yes.
a sustainable asset. I have to get compliance to agree to buy it. How do you deliver that to me as a miner? An asset, a coin, a specific piece of property.
Well, what we do is as Hive does, is that we mine these virgin coins. They're untainted. They've not been anywhere that's bad. And we hodl them. And we just continue, and we mine Ethereum Classic, sell that, they'll pay the electrical bills, and keep hodling. And so we think, and we think that our coins are more valuable because they've been untainted. And they've only come from green energy, and they should have a two-tier price system, and our coins should be more valuable. That's what I personally think.
Whoa. So you are basically going against the fungibility argument that Jason just made, that all coins are basically the same and valued the same as they transact around the world 24 hours a day, but you're saying your Frank coin...
Not Frank coin, it's a Bitcoin.
But it's a Frank Bitcoin.
No, but it's what I'm trying to share with you is that our Bitcoins are green energy, and they have not been anywhere someone could tag them being in a dark pool, etc. I know that this is a big issue, whether there's software out there to make sure those coins are clean. So I believe that these coins are very special.
I have been in Bitcoin for a while, and
Yes, you have.
I have heard people always talk about, these mine coins are going to be worth more. And you show up, and I don't see that in the marketplace. I talk to these OTC desks. No one is seeing that. And I think the people you're speaking of, they say that, they think that, but when they come up to the desk and they say, I want to buy one Bitcoin, are they really going to pay 20% more?
Well, we have an obligation here because the way I set this up is I simply ask the institutions, give me your questions. I am simply a messenger.
Right.
And so I am asking them, are you interested in allocating to Bitcoin specifically? These are very large pools of capital. And generally, they haven't made that decision yet for one specific issue. They don't want to get caught up in this turmoil, this debate, this issue that we're talking about now, and we should, because we need to send a message to them. We need to solve it for them.
But there's a way to do it which has nothing to do with the mining end.
Let's hear your idea. You're speaking to them directly right now.
Which is essentially, a financial institution could create a fund where they only buy Bitcoin that has been sustainably mined, and then institutions can invest in that fund. That's a way to do it without the miners having to even think about the difference in our coin.
But aren't you bifurcating when you say that? You're saying this coin is mined sustainably versus the historic coins that we don't know what the carbon footprint was from 17 years ago.
So the problem is there are only 900 Bitcoin mined a day. And so to build a volume of coins sufficient for the $1 trillion that you're advocating the institutions would want to have, there's no way you can get it by newly mined coins. If they're going to go into the asset class, they have to go into the broader asset class if they're going to get any volume.
That's one answer. The other answer is the value of a coin that was mined sustainably becomes very, very high because they're allowed to own it, and they're willing, as Frank is saying, my coin's different than your coin because it's done on a green basis. They'll pay more for that. Do you buy that?
No, I think we at various times have believed that financial institutions would pay different prices for different types of coins. And what I've learned is that they won't actually, because to Jason's point, yes, if you ask them the question, is it more valuable to you? Yes. Will you pay more for it? Most probably not. That's the answer I'm getting from financial institutions.
But you just want them to buy it in the first place. That $1 trillion is outside of this room waiting to come in. That's the way I look at it.
Yeah.
I own the coin because I think we will solve this problem one day, and I say that collectively. When that happens, there'll be a geometric increase in the value of my coins, whether they were mined sustainably or not.
But I think if a person wants exposure to the asset class, and this is the unique thing about Bitcoin, it's so limited in supply that if you wanted an exposure to the asset class, you're going to have to buy the broader market. There's no way. You can invest in public company stocks like us miners. You can invest in other ways to get exposure. But if you really want to hold Bitcoin, either via a fund or directly, the only way to get a $100, $200 million allocation is to go buy it in the broader market.
All right, let's go down that path. Let's talk about owning the stocks of your public companies as opposed to owning the coin you mine. Is there a thesis out there that you will eventually trade at with the same volatility that the coin has?
Well, I think historically, at least Riot and Marathon, you look at our stocks, almost regardless of what we announce, Bitcoin moves, we move kind of in lockstep. There doesn't seem to be a lot of differentiation in our stock prices relative to the news we announce. It's really very much driven by what Bitcoin does. We're a proxy.
We all have the same DNA of volatility. On a daily basis, it's plus or minus 6%. It is funny, as strangest thing is the same as Tesla. It's just the same DNA of something that's perceived as being disruptive. But I want to come back to something that's really important. When I first went to trying to launch an ETF, the pushback from the regulators, the SEC, was AML, anti-money laundering laws. And they were very concerned of some hacker getting paid Bitcoin and was going to show up in the New York Stock Exchange. And they've still not figured a way out to resolve that. So that is where I have this thesis that us hodling every coin we can and owning on our balance sheet, and it's never been in the dark cloud, it's never been out in that cyber world, it will over time have a greater value. And I think most of the miners are hodling as much as possible, and those coins are great coins.
So let's talk about the regulator, because what's happened over the last 36 months, and not just domestic, Switzerland, France, Germany, New Zealand, Canada, most of the European countries now have come to the conclusion that cryptocurrencies are here to stay, and eventually all currencies will somehow be fungible in a digital form. You think about just the idea of a $2 trillion stimulus package here domestically. Can you imagine the ESG issues around printing $2 trillion with paper? That's never going to happen. So that's going to be some form of credit form, which is in itself digital. Now, regulators in Canada were the first to allow Bitcoin in the ETF wrapper. And the assumption is, and I'd like to get your estimates, this is a very interesting asset class for individual investors, obviously. We do not have that here domestically. When do you think that happens?
We've been waiting for an ETF for 4 years. One ETF, there's always a sweat around that ETF. I think it's a positive for the industry when regulators finally wrap their head around it. But I think there's almost an upside to the delay as well, because if people want to get exposure to Bitcoin, they don't have an ETF to do it, well, then they have to learn about Bitcoin and they can learn about custodying it for themselves. So it's almost, this delay almost works in our favor. It gets more people understanding Bitcoin.
Okay, so to do that, you have two options. You either go through the learning process of a decentralized ownership, or you go to a centralized ownership like a wallet that you can basically download off your phone and buy. There's two different friction levels of cost there. The centralized systems are very expensive versus other financial assets. Not very expensive, really expensive. When you look at the basis points charged for these services versus if you learned how to go decentral. 9 out of 10 people can't do it. It's too complicated.
Yep.
The industry itself has not solved the friction problem. Either you pay a lot, or you don't do it at all, or you get someone to teach you how to go decentral and start working with the MetaMask and everything else that nobody knows how to use. That's a problem for your industry, is it not?
Well, I think there are a couple things going on. One, you may have read about the announcement that FIS is rolling out custody, buying and selling of Bitcoin to over 300 million US bank accounts through a platform provided by United. That's 300 million people who will, using their bank app on their phone, be able to buy, sell, and hold Bitcoin. You can do it with PayPal and Venmo today, Square, et cetera. There are ways to do it with fairly low friction, but to your point, there are fees associated to it that make it expensive. One of the most rapidly growing sectors in the industry is Bitcoin ATMs, and those are predominantly used by people who are sending money back home to their families. Because if you look at the MoneyGrams of the world and the fees that just payment organizations charge for sending money to the Philippines or wherever home it happens to be, it's very high. It can be up to 20% in some parts of Africa, for example. So being able to buy Bitcoin in an ATM, excuse me, and send it back home has been a rapidly growing market. I mean, there are tons of Bitcoin ATMs being deployed across the US today. The US banks want a piece of that business too. So I think the cost of ownership for Bitcoin is going to commoditize here over the next few years. It's going to become very easy to hold, very easy to trade. There'll be tons of ETF type instruments, whether you want to hold public companies that are in the Bitcoin world, whether you want to hold Bitcoin itself, balances of crypto with other baskets of crypto with other currencies. I think we're going to see a plethora of products that people can buy and sell to get exposure to Bitcoin, including just holding it in your bank wallet on your phone.
What about the thesis, going back to what you do? And there's someone that's not here today, Hut 8, the woman that runs that, told the institutions that were looking at her stock, I will never take a single coin off my balance sheet. Every single one that I've mined is staying on my balance sheet. If you want to own Bitcoin, just buy my stock. It's all mined sustainably. I'll never sell it. You'll be a shareholder of a portfolio, and I will know the provenance of every single coin. How do you feel about that idea? For solving for the problem we've been discussing, the $1 trillion prize.
So I think just the ability to own the printing press versus buying the books, which is the analogy most people use for Bitcoin. You're either a printing press for printing money or owning Bitcoin itself. It all depends on what sort of exposure you want to volatility. But I think for people who want to hold Bitcoin, most of the miners today are holding it because they believe the Bitcoin they're producing is going to be more valuable in the future. Many miners can do yield farming to generate income off that Bitcoin, so they're not having to sell it to pay for operating costs. But as Bitcoin price grows, yeah, there'll most probably be pressure, and miners will sell some volume of it because they're going to be driven to grow themselves. And I think it's a capital-intensive business. Miners will hold Bitcoin as long as their balance sheets let them do it. There comes a point, though, where they have to start spending it to fund their growth operations.
They don't have to. They can basically lend it out on a DeFi basis and get fiat back to pay their bills, right?
Right, but if you think about the Bitcoin market, what many people outside of the Bitcoin community don't realize is 900 Bitcoin a day. It's a fixed volume until the next halving. The global difficulty rate, the hash rate, continues to increase. If it increases 40, 50% a year, effectively any public miner's market share of that 900 Bitcoin reward will decrease unless they are spending to grow their infrastructure by 40 or 50% a year. The yield they get off the Bitcoin they hold on their balance sheet most probably isn't enough to fund that. And they're either going to have to sell more stock, raise debt, or...
Jason, this goes to the real issue. Right now, the public markets have essentially dried up for a lot of miners that want to raise capital that are not public yet. There are about 7 deals that I'm aware of that I was interested in taking a position in that have just ground to a halt. And when you ask the bankers who have a great interest in getting these things done, because they get paid 5 to 7% fees, they would like to clear these deals, but they can't get right back to the same problem. The institutions won't buy it because they're waiting for the answer to this sustainability issue. They don't want to be tagged supporting the idea that they're going to use every piece of electricity or drop of power that man's going to need for the next 2 years just to start some New York facility, which it's one of the deals that actually collapsed. It was supposed to happen with hydropower, it didn't happen. New York put this potential moratorium in its state for 36 months. The capital dried up right away. What do you say to the?
Well, I think at Riot at least, and I'm sure other Bitcoin mining companies as well, we are still seeing a lot of interest in investing in these companies. Our stocks all have an incredible amount of volume. We trade over $1 billion in value in a day quite often. There's a lot of people still interested in the stock, so that gives companies like Riot, Marathon Hive, a very efficient access to capital to grow our business and allow us to retain as much Bitcoin on our balance sheet as possible. You mentioned the New York bill. I'm not really sure if that's going anywhere because I think the underlying story for Bitcoin mining and its relationship with renewable energy is important. Bitcoin miners come in, they are the buyers of energy of last resort. And where you find that is congested energy, surplus energy, energy that cannot get to people. Bitcoin miners are indifferent to their location. They're indifferent even to the time of day that they will consume power. And that's, if there's certain policymakers, lawmakers in New York that haven't seen that yet, I'll tell you, the lawmakers in Texas do see that. That's why we're so happy to be running our business in Texas going forward.
I want to give you a question that I thought was the best, okay? One institution said this: the industry has no voice. It has no one to tell its story to policymakers. They pride themselves in decentralized thesis and theory and the origin of Bitcoin, and yet they have no voice when it comes to a New York policymaker saying, I'm shutting it down because it's bad. How does this, it's your industry, where's your voice? What happened here?
I think I think we're starting to see now the formation of different players in the industry starting to talk to each other and say, what can we do to help the community? What can we do to promote the good that Bitcoin can bring, the good that decentralization can bring, and try and create transparency in data and information to the regulators and to the general public. I think the North American Mining Council, it's kind of the working name, if you would, that is in the process of formation, is a first step in bringing the industry together to kind of talk about things, share information, make commitments about what we intend to do, and then educate legislatures, educate lobbyists about really how the market works.
You're referencing the Elon Musk phone call with miners.
Yes, that he was on a call with the group of miners, but the group of miners, all of us here on the stage included, are moving forward to become more transparent about the information we provide, really to educate regulators in the marketplace, the common man, if you would.
Let's ask this audience, packed in here.
Kevin.
Does this industry need a voice? Yes or no?
So Kevin, I think the biggest thing with this is when I first went in the business is transparency. And that was a big issue of getting transparency of your costs. Because being a public company, you want to be able to get more and more information. When you're mining, everything's transparent. Blockchain is transparency. So I think that this industry as a group was only to be able to pull together to give more transparency on sources of energy, in particular where the sources are, what we're paying for that, And that's really the element to take on the sort of anti-crypto. And what's interesting for me to hear is yesterday that a lot of it's coming from Ripple. Ripple's centralized and we're decentralized. And so a lot of this narrative that's so negative, I think that we're in a great position, and I want to share what we're doing in Boden in northern Sweden. We give back to the community. We have software that can go from 20 megawatts to 1 in 15 seconds. A hydro company can't do that at peak periods. And then we go right back up in mine. And so what does that do? It helps the infrastructure, the community. We're highly respected and regarded, and we go on mining. And then they turn around and call us up, and they want us to participate on an expansion of 10 megawatts. Very attractive terms, because that's part of the
Your point is you're
ESG
innovating
of
to solve this
sustainability.
issue.
So I think, let me finish. I think what's going to happen with this group is that we're all bought into, let's tell a better story on ESG.
Okay, we're at zero time now, so last word you, Jason. Voice, no voice for this industry. And are you a voice?
What I think is important is the story that Bitcoin miners, Riot, all of us on stage are using more and more renewable energy is a good one. But I think the story that needs to get out there is that this is not something that's just being done out of the goodness of our hearts. There are market forces in energy markets like ERCOT that are connecting loads like Bitcoin miners and renewable sources, and they are making those more viable. We're set up in ERCOT, Marathon's set up in ERCOT now. I think it's a great choice. And it's not just, oh, we are using this much energy. Bitcoin miners are helping more renewable energy to come in because they have a load like Bitcoin mining. And I think all of us telling that story, however that comes together, vehicle, medium, it's a good one.
Oh no, you're a capitalist. Ladies and gentlemen, we've run out of time here. Let's have a hand for these gentlemen who came into the digital Shark Tank here today. Thanks, guys.